Narayana, can you expand on the thought, and I've heard you talk a little bit about this before, in when you're looking at adjusting monetary policy, what length of time frame do you use in setting those policies? In other words, it's not a short-term vision, right?
Well, yeah. So this is a good question. I mean, the FOMC meets every 6 to 7 weeks, so it's meeting 8 times per year, and it's reacting when doing so to the evolution of economic information. But one of the challenges is that with the making of monetary policy, Milton Friedman had a very famous phrase that it's subject to long and variable lags, which means we don't know exactly how long the lags are, but they're typically longer than what people have in their heads. It's not like we do something, the FOMC were to do something in a given meeting, and then the next day that has an impact on the economy. So generally, I'll speak for myself here, I'm thinking a lag of about a year or two when we're thinking about the impact of policy. So that's hard. That's what makes the job challenging, is you're watching the flow of information and trying to have forecast then how conditions are going to be changing over the next year or two to influence your choices today. Beyond that, of course, you're trying to keep in mind, but I think we all do this in all our businesses as well, that you have to react to short-term changes in the context of a long-run framework. And sometimes when you're reacting to short-term events, you can lose the grip on the longer-run framework. So that's another challenge that I think is with this. But as business, any walk of life, I think you're familiar with having to keep track of the long run, but also trying to react to the short term.
Since you've made one trip here, you've formed some impression. There have been articles in the Ninth Federal Reserve magazine. What do you expect to show your board, and what do you expect to come away with?
So that's a great question. I think that one of the reasons I was very excited about having our board of directors come out here. Did everyone hear the question first of all? Okay. So I think that one of the reasons that I was very excited about having the board come out here is I've heard reports from people who were from the local community about what was happening here. I do not think it's easy to grasp I think both the economic vitality of what's happening in this part of the world, as well as I think the very real challenges that go along with that economic development. It's one of those things you hear about in the abstract, but I think being confronted with in the concrete is very valuable. Beyond that, we're going to hear from a lot of local experts about what's going on, and I think that in and of itself is very valuable. So I think that's the kind of thing we're looking for. I'll say that for those of you who are living in this part of the world, you may not always appreciate how special it is in terms of its economic vitality. That I hear reports from all over the United States and really all around the developed economic world, and this part of the United States is certainly quite special in terms of how much vitality we're seeing out of here. The recovery from the Great Recession that hit the United States from 2007 to 2009 has been a very slow one, and so you don't have that same feeling of economic vigor everywhere in the country that you certainly experience here.
So let's take that one step further. You take the information you have, you meet every 6 to 8 weeks. We're a very small part of the country, a very small population. Will that have any impact at all, in your deliberations on monetary policy down the road? What will you take away from this in regards to that? So, to be totally honest, we're not going to make monetary policy just based on Minot. But would that we could, in the sense that if the rest of the country was like Minot, we'd be happier about it. Well, to be more serious about it, it's a bunch of pixels, right, that you're trying to put together. And why is it? I think it's important to share this particular piece of information about what's happening here for a couple of reasons, I think. One is
I think it's important to hear that there is possible to have economic vigor in the United States, and I think that's an important lesson and message to share. Beyond that, I think it's instructive, and this is something I'm especially interested in, is to try to understand the segmentation, to use a technical economics language, segmentation in labor markets. So what's happening here? How much is it spilling over to, let's say, western Montana, eastern North Dakota, western Minnesota? Now we're talking about very geographically proximal areas, and it's surprising to what extent we see even barriers across these, in terms of the spillovers, in terms of employment and wages, in terms of economic success, spilling over these rather proximal areas. I think this is an important lesson for us to be thinking about as well when we think about the challenges facing the country, about how easy is it to adjust to shocks. Here we're talking about a positive one, but how easy is it for the country to adjust to an adverse shock? So I think there's an economic lesson I'm hoping to learn as well, I'm trying to learn more about. But just in terms of this, the data we're getting from here, I think because this part of the country is so unique, it is important to share the information about it. Terry.
My mother is 94, and she's not very happy about the interest rates that we're paying on CDs at our bank. Tell her about when we're going to start raising those rates.
That's from a banker. Mom's mad at her.
So I'm sorry to hear about your relationship with your mother, but so I'll say so. I'll talk about the question in a serious way. I think that monetary policy has distributional consequences, and I think that when you keep rates low, as the Federal Reserve is doing, on net, on net, it benefits the entire economy for reasons that I'll talk about in a second. But it's going to benefit people who are borrowing in that kind of position more than it's going to be benefiting savers. And that's always true. Now, it happens to be that policy is extraordinary, to use the language of the FOMC statement. Interest rates are extraordinarily low, and so these distributional consequences are more marked than usual. But why is it the FOMC is doing this? Why is it that the committee is keeping interest rates low? It's because on net, you're trying to stimulate demand for current goods. You're trying to make people think to themselves, I'd rather spend money today than to save it. If you're a business, you'd rather have them spending it on building a factory, hiring a worker, as opposed to keeping it in the bank. By keeping rates low, you're incentivizing them to do that. Now, to answer your question, the FOMC projects right now that economic conditions will warrant keeping rates extraordinarily low at least through late 2014. So that's in the FOMC statement.
More just a comment for your board. As you see the economic vitality, you see what's going on, and I know your Fed Gazette covered part of this, recognize that about a year ago we had 4,100 households displaced.
Yeah.
And the statistic and I run the local chamber, and the statistic I like to use is at Sherwood, which measured water coming into the United States, measured water for 89 years. And on June 22nd last year, more water passed that gauging station in a single day than passed that gauging station for the entire year for 45 out of those 89 years. And so while we're experiencing a boom, we're also experiencing a very, very significant rebuilding of our community. And both are happening at the same time, and our mayor, Kurt, I don't see where Kurt is, I know you're here. Kurt would say it's a tale of two cities. You've got the valley and you've got the two hills. And so while there's a huge economic boom, there's also a tremendous amount of stress going on in the community.
I think these are great lessons for us to take away, and if you'll permit me, I'll try to make them even bigger than what you're describing, in the sense that it points to, as a macroeconomist, which is what I used to do as a professor and now I do as a policymaker, there's a tendency to focus on aggregates, what's going on, real GDP, inflation, the numbers that affect the country as a whole, and we have to focus on those. But it's important to remember that there's a lot of differences that underlie that. And here you're talking about a city of 40,000, and even there you see that those kinds of differences, that kind of heterogeneity is an important part of the economic experience. And I think it's valuable for all policymakers to keep that in mind. I guess we're going to go back here, sorry.
Changing tack a little bit, looking at the economy and talking about the Great Recession that our nation is trying to come out of, have you started receiving much feedback yet about the Basel III requirements on all banks and what that will do to our communities and our small businesses who won't be able to get the loans they need to expand?
So that, I personally am not really engaged in that conversation. That's a conversation that's taking place more between the Board of Governors and banks, because the Board of Governors writes the regulations and we go out as and implement them once they're written. So certainly there's a dialogue going on, I think it's important that comments be made and be heard about the kinds of tensions that you're emphasizing. I think that if you look at the large financial institutions of the country, certainly I personally think it's good that they're holding more capital than they were in the past. And then there's a question, though, about how you tailor those regulations for the again, it comes down to heterogeneity. How do you tailor those regulations to deal with the very different kinds of experiences, different kinds of structures that institutions have? But I would, at this point, I would just say certainly there's a dialogue ongoing, and the kinds of concerns you've expressed are being expressed, I think, quite forcefully. Yeah, white shirt.
How can we explain to our general public that was hurt very badly, the senior citizens during this flood? Their investment was in their home. They were told in many cases they did not need flood insurance anymore because of the dams that were put in. 20 years ago, they were receiving maybe 14% on their CDs. Now they're lucky if they even get 1.5 cents. Their homes are gone. They said, what are we going to do? We were told all our life to invest in good investments. Well, are CDs good investments today for a senior citizen? Or are they not? What has happened between now and 15 years ago, and especially when presidents are getting huge bonuses of banks and so forth, and the money just isn't there for this person that's 80, 85 years old? What do you tell them?
Well, that's a challenging situation you're confronting me with. So let me talk a little bit about it, though. So I'm going to try to make a distinction, which I think is a very important one, between what economists call real interest rates versus nominal interest rates. So when you just think about 14%, which is the number that goes back really to the early 80s or so, people would have been able to earn that kind of interest. But part of that was because inflation was so high. So the real interest rate they were getting, that is their ability to grow what they could actually go out and buy in the store when they invested, that was actually actually negative, I think, at that point in time. And that's really what you want to focus on as an investor, is on the real interest rate. But again, if you look at the real interest rate, so one way to think about that is if you buy their TIPS bonds that are being issued by the government. These are Treasury inflation protected securities. If you buy one of those, there's 10-year bond, it'll actually pay a negative real interest rate. Now, what does that mean? That means that if you put $1 in today, you're going to be getting less than $1 back in terms of purchasing power in 10 years. Now, why is that? Part of it is because of anticipations of Fed policy, but we just talked about what the Fed has said about its policy. It's not talking about 10 years from now. It's talking about a relatively shorter time frame. What's happened after the shock that we went through in 2008, and it's happening all over the world, is that people are more afraid, they're more nervous, and they want to save. And if everyone wants to save at the same time, what has to happen is the interest rates fall. And the people who whenever you try to do something in economics that everyone else is doing, it's hard to get a good return on it. And that's what's happening to savers right now. They're being squeezed in that kind of bind. I don't have a good answer in terms of that, in terms of what the solution to that problem is. It's simply that through policy and through healing, we have to get to a point where people don't feel that sense of fear and uncertainty anymore. Yeah.
As an economist and a member of the FOMC, do you think stagflation is something that we might witness moving forward in the future?
So the question's about stagflation. So people use that term in different ways. I mean, right now we have, so to set some context. So right now, unemployment is quite elevated in the United States. It's 8.3%, very high relative to historical norms. Inflation, by way of contrast, is running by year-over-year measures are running below 2%. So right now, typically people would think of inflation as being actually below what the Fed wants it to be. The Fed was aiming for 2% target inflation. Now, I think when people say the term stagflation, they often have in mind something along the lines of what we had in the 70s. That would require bad choices by the FOMC, I think. I don't anticipate bad choices by the FOMC, so I don't anticipate stagflation. Now, do I anticipate the possibility that inflation could rise above 2%? That's something I've talked about publicly as being certain that could happen. But in a context, in a world in which unemployment is as high as it is, could well be part of an appropriate policy where you've got two objectives, two mandates you're supposed to fulfill. If you might be willing to give a little bit on the inflation one to do a little better on the unemployment one. Sorry, you've had your hand up for a while.
You know, you say you're coming out here to see how, Western North Dakota is doing. If you only come away with that, I would be disappointed. Because I think you should really take a look how important the Bakken Formation and how it was developed is impacting the world economy. I mean, everything, all the research and development that people know about fracking, about shale, about natural gas, everything like that, the vast majority of research and development was done here in Western North Dakota. And I just heard something this morning that I was talking with somebody, they said they're going to start using warm water they think will be more efficient than cold water in getting this fracking. But this fracking that they're doing here, they're taking to Texas, to Pennsylvania, overseas. And you should just take back to Minneapolis what this area is doing, not only in the research and development, but we're went from 50,000 barrels a day 10 years ago to 1.5 million barrels a day probably in the next 2 to 3 years, and the impact that that's going to have throughout the world.
I think it's a great comment. I mean, I've been emphasizing the local nature of our investigations, but if someone asks me the global consequences of what's happened in the Bakken, if I just think about the oil right here, the global consequences are actually not, frankly, that large. But the technology development, that's a huge consequence for the world because that can allow us to extract energy more cheaply and to make energy available to people more cheaply around the world. That's hugely beneficial. So I take your point, and it's absolutely right on. Yeah. Oh, sorry. Yeah, I've been.
We have a housing, very robust housing market. We're getting some pushback from underwriters that there possibly be a bubble. Does the Fed Reserve have a policy on housing as we go forward based on past experience?
I'm sorry, I couldn't quite get the question. So could you?
What is their policy as far as housing financing goes? As you get in an area where there's a bubble or potential bubble going on housing?
It's important, I think, to on an ongoing basis to be sensible with underwriting, and my understanding about what's been happening in the 9th District is I think that banks have typically been following pretty sensible procedures along those lines. Yeah. I'll come back to you.
Fed has used up a lot of its so-called bullets in trying to address the recession. I'm wondering about the likelihood that the Fed will reduce what they pay on excess reserves as a way to induce banks to lend. What's your thoughts there?
So right now, the Federal Reserve is paying interest on excess reserves of 25 basis points, 0.25%. There is some room to reduce that further as a way to incentivize banks to lend, but there's not a lot of room. So it is a policy tool that's left, but it's a policy tool that I suspect would have only minimal effects on the economy if utilized.
What's the likelihood
It's certainly one of the tools. It's certainly under. If it came to the point of the Fed providing more accommodation to the economy, that is, easing monetary policy further, this would be something that we would think about. But I can't offer you a probability assessment beyond that.
I think maybe one more question.
Okay. Yeah, you're on.
Well, pardon me for being overly simplistic, but I hear about liquidity injections and quantitative easing, and I sometimes wonder, is that the same as printing money or whatever? And so, one thing I have not been able to track, I can track the deficit and I can track the debt, but I can't seem to track how much money we're printing, if I can be overly simplistic. Is there a good source of accurate, honest information as to how much money we are printing?
I mean, that's something that is available. I think I'm going to forget the exact tables that are available on the Federal Reserve Board of Governors website, but we can get back to you with that information. So the Fed is, the business, when the Fed goes out and buys long-term assets. So I'll try to back up and give a little bit broader context. So in November of 2010, the Fed engaged in a large-scale asset purchase. So what does that mean? That means that the Fed bought say about $600 billion over the next 10 months or so of longer-term government securities. Now, how do they finance that? It's by basically creating bank reserves, reserves for the banks will hold. So that's the trade, is you're buying long-term and going short in the sense that you're having banks hold reserves, hold deposits with the Fed, and that's how you're financing it. Note that those reserves can be when you think about the money multiplier argument that people usually make, those reserves are basically putting a cap on how much money can be created in the system. But that's all sort of irrelevant right now because there's so many excess reserves in the system. When people say excess reserves, that means that the banks are holding reserves well in excess of what they would need, given how many deposits that they provided to their customers. Generally, if they were able to, if they were paying a high interest rate to their customers on their deposits, and relative to what the Fed was paying, that there would be no excess reserves in the system. The reason there are excess reserves in the system is because basically the interest rates are relatively similar between what the Fed is paying on those reserves and what the banks are paying on their deposits. This, so that's the Fed is financing it through the creation reserves, but those creation reserves are not putting pressure on in terms of, they're really not serving, I always think of them as a license to create money, but they're not being used. They're just being sat on right now. Is that helpful? A table?
A good, really good resource.
Yeah, sure. I'm sorry. Yeah. I got myself into it. I apologize. Yeah, that we can definitely, there's tables after table after table about that. We've got people who can give you an answer to that. Yeah. One more, okay.
This one might be interesting. If Milton Friedman were alive, he'd be 100 years old today. You went to school at the University of College. Either you probably had him as an instructor or you studied his works. What would he say today about the monetary policy that's in effect?
Yeah, I'm gonna. It's unfortunate to end on this question because I'm going to have to pass. I think it's. I would really, I don't really know the answer to it. And so I will say this, and I think we can, anyone who's had the privilege of hearing Professor Friedman, which I did, he would be expressing himself with great forcefulness, whatever view he took. But beyond that, I would really hesitate to say. Thank you very much for your time.